When money gets tight, wealthy households cut things in a fairly predictable order. The vacations go first. Then the dining out, the subscriptions. Sometimes even the car gets downgraded or the second home gets rented out for a season. Almost everything on the list gets touched eventually, if the tight stretch goes on long enough. Except one line item. Across every wealthy family I've looked into, every financial planner's account of how their higher net worth clients actually behave in a downturn, there's one specific premium that stays exactly where it is, fully paid, month after month, even while everything else around it gets trimmed. It's not the mortgage. It's not even life insurance, which most people assume would be the untouchable one. And it isn't glamorous. It isn't something anyone brags about at a dinner party, which is probably exactly why it's the one expense nobody ever talks about, even though the people with the most to lose treat it as completely non-negotiable. I'm going to tell you exactly what it is, why wealthy households treat it as completely non-negotiable, and why the numbers behind it should probably change how you think about your own budget too. If you're new here, hit subscribe. I break down exactly this kind of thing, the specific financial habits that separate how wealthy households operate from how the rest of us default into operating, every single week. Here's the expense. Disability insurance, sometimes called income protection insurance. Not health insurance, which covers medical bills. Not life insurance, which pays out if you die. Disability insurance replaces a portion of your actual income if you become sick or injured, and simply can't work for an extended stretch of time, whether that's 3 months or the rest of your career. It's the least glamorous, least discussed form of insurance that exists, and it's also the one wealthy households treat as more essential than almost anything else on their monthly statement, because of a single piece of math that almost nobody outside of financial planning circles ever actually walks through. Here's the math. 9 out of 10 people, when surveyed, estimate they have somewhere around a 16% chance of becoming disabled during their working years. The actual number is dramatically higher than that. A 20-year-old entering the workforce today has roughly a 1 in 4 chance of becoming disabled before reaching retirement age. Men face something close to a 43% chance of a serious disability during their working years. Women face something closer to 54%. At age 42 specifically, you are about 4 times more likely to become seriously disabled than you are to die during your remaining working years. Let that sit for a second, because it inverts almost everyone's instinct about which risk actually deserves the bigger premium. Most households insure against death aggressively and completely ignore the risk that's several times more likely to actually happen to them. And this isn't really a story about accidents, which is where most people's minds go first when they picture becoming disabled. The overwhelming majority of long-term disability claims, somewhere around 90%, come from illness rather than injury, and close to 97% of all disabling conditions happen completely outside of work, which means workers' compensation, the safety net most people assume would cover them, simply doesn't apply. Back and spine disorders account for close to a third of all long-term disability claims on their own. Cancer accounts for around 15%. Mental health conditions and pregnancy-related complications each account for roughly 9%. None of these are freak accidents. They're the ordinary illnesses and conditions that show up in any large enough group of working adults over a long enough stretch of time, which is exactly why the odds are so much higher than intuition suggests. Here's why wealthy households specifically treat this as untouchable, and it comes down to a term financial planners use called wealth at risk. For someone earning a high income, the actual asset isn't just the house, the portfolio, the business. The single largest asset most working people have, wealthy or not, is their own future earning capacity, the total sum of every paycheck they're going to bring in between now and retirement. A doctor earning $300,000 a year for the next 25 years is sitting on roughly $7.5 million of future income, an asset larger than almost anything else they own, including their house. And yet the same person who insures that house for its full replacement value The moment they buy it will often go years without ensuring the income that actually pays for the house in the first place. Wealthy households, or at least the ones working with a competent planner, understand this asymmetry clearly. The house is replaceable. The specific decades of earning capacity you'd lose to a disability at 45, in your peak earning years, are not replaceable at any price. The math scales in a way that actually makes this more urgent, not less, the higher someone's income climbs, which is precisely the opposite of how most people intuitively think about insurance. A household earning $50,000 a year has less in absolute dollars to lose, but they're also more likely to have some form of safety net through public assistance programs if things go badly wrong. A household earning $300,000 a year has an enormous amount of future income at stake, almost none of which is replaced by public programs designed around a much lower income floor. The math genuinely favors protecting this specific risk more aggressively the more successful someone becomes, which is exactly backwards from how a lot of people instinctively think about it, assuming that once they've built up enough savings, insurance becomes less necessary rather than more. Here's what happens to people who don't have this protection when a real disability actually hits, because the safety net most people assume exists is dramatically thinner than they think. Social Security disability insurance, the federal backstop most people vaguely assume will catch them, denies close to 70% of initial applications. The ones that do get approved take 3 to 5 months just for an initial decision, and if you have to appeal, the current backlog runs to roughly 9 additional months on top of that, all while you have no income. Even once approved, the average SSDI benefit right now comes out to about $1,630 a month, which is genuinely below the poverty line for a 2-person household. That's the entire safety net for the majority of American workers, who don't have anything beyond it. And only around 35% of private sector workers even have access to long-term disability coverage through their employer at all. 51 million working adults in this country are currently carrying zero disability coverage beyond that thin federal backstop. Think about what that actually means for someone earning a genuinely high income. If Social Security disability approves your claim at all, and there's roughly a coin flip chance it won't on the first try, the maximum monthly benefit even for the highest earners tops out well below what most professional households actually need to cover their mortgage, their car payments, and their ordinary cost of living. A household built around $150,000 or $200,000 a year in income doesn't just take a pay cut down to $1,600 a month. It falls off a cliff. And there's no appeals process fast enough to catch a family before the mortgage payment comes due the following month. The consequences of that gap show up in a statistic that genuinely surprised me the first time I read it. Disability causes somewhere between 46 and 50% of all mortgage foreclosures in this country. Death, by comparison, causes only around 2%. The thing most households insure most aggressively against, dying, is responsible for a tiny fraction of the foreclosures that disability alone accounts for, almost entirely because households prepare thoroughly for the risk they fear most and almost completely ignore the risk that's actually statistically far more likely to hit them during their working years. It's worth sitting with that gap for a moment because it says something uncomfortable about how most financial planning actually gets done in ordinary households, driven far more by which risk feels most frightening to imagine than by which risk the actual numbers say is most likely to show up. I want to say something specifically to the 30, 40, and 50-somethings watching this, because you're sitting in exactly the window where this risk is highest and the consequences of skipping it are largest. You're deep into your peak earning years, which means the dollar value of what you'd lose to a disability right now is bigger than it's ever been. You've likely got a mortgage, kids, obligations that don't pause just because your paycheck did. And you're old enough that the actuarial odds of a disabling illness or injury, back problems, cancer, a cardiac event, a mental health crisis, serious enough to keep you out of work for months, start climbing meaningfully compared to your 20s. This isn't a young person's risk that fades as you get older and more established. If anything, it's the opposite, and it's precisely the demographic least likely to still have cheap, easy to qualify for coverage sitting around from an employer they left a decade ago. Let me walk you through what this actually looks like for one household. Take a man I'll call Marcus, 44, ran a small architecture firm, earning around $180,000 a year, comfortable, careful with money, the kind of person who genuinely thought he had his bases covered. He'd let his individual disability policy lapse 3 years earlier during a slow stretch for the business, telling himself he'd pick it back up once things stabilized. The exact same reasoning that leads a lot of people to quietly let this specific coverage go first when money gets tight, precisely backwards from how wealthy households actually treat it. A back injury from a fall on a job site kept him out of work for what turned into 14 months. His firm's revenue collapsed without him running it. Social Security disability denied his initial application, and by the time the appeal came through, his family had gone through almost all of their savings and had started drawing against their retirement accounts just to keep the mortgage current. He told me the disability policy had cost him around $400 a month when he let it lapse, roughly 2.5% of his income at the time. 14 months without it cost him well over $200,000, once you count the lost income, the retirement withdrawals, and the penalties that came with pulling money out early. What actually stayed with him, he told me, wasn't the specific dollar figure. It was how ordinary the decision to let the policy lapse had felt at the time. Business was slow for 2 quarters. The premium was one of a dozen expenses on a spreadsheet, and cutting it felt exactly as reasonable as cutting the office coffee service or the software subscription he barely used. Nothing about that decision felt reckless in the moment. It felt like normal, prudent belt tightening during a rough patch, the kind every small business owner does at some point. The injury that followed had absolutely nothing to do with the business slowdown that caused him to cut the policy in the first place, which is exactly the disconnect that makes this risk so easy to underestimate. The decision to drop the coverage and the event that made him need it were completely unrelated, separated by 3 years, connected only by bad timing that no spreadsheet could have predicted. If you've never actually checked whether you have disability coverage, comment below and let me know, because based on the numbers, there's a genuinely good chance a meaningful share of you watching this are currently sitting exactly where Marcus was the week before his accident. Not because you've been careless, but because this is genuinely the one risk almost nobody thinks to ask about until they're already living through it. So here's what to actually know before you go looking into this yourself, because the specifics matter more than the general advice to just go get some coverage. First, check what you already have through your employer, because a real share of you already have some baseline group coverage and simply don't know it exists. Ask your HR department specifically whether you have short-term and long-term disability coverage, and if so, what percentage of your income it actually replaces, because group policies often cap out lower than people assume, sometimes at a flat dollar amount that falls well short of a high earner's actual needs. It's also worth asking whether that group coverage is portable, meaning whether it stays with you if you leave the job, because a lot of employer-provided disability insurance disappears the moment you change. Employers, leaving a gap in coverage right at the point in your career when your income, and therefore your wealth at risk, is climbing the fastest. Second, understand the difference between an own occupation policy and an any occupation policy, because this single clause matters more than almost anything else in the contract. An own occupation policy pays out if you can't perform your specific job. A surgeon who loses fine motor control in their hands, for instance, even if they could theoretically do a different kind of work. An any occupation policy, which is what a lot of cheaper group plans default to, only pays out if you can't work in any job at all, a dramatically higher bar to clear, and one that leaves a lot of genuinely disabled professionals without a payout, simply because they could technically still do some lower-paying job. This distinction matters enormously more the more specialized your career actually is. A surgeon, a pilot, an attorney, anyone whose income depends on a specific, hard-won skill set faces a real risk of being technically employable in some capacity, while being completely unable to do the job that actually generates their income, which is exactly the gap an any occupation policy leaves uncovered, and an own occupation policy is specifically built to close. Third, on cost. Individual disability insurance typically runs somewhere between 2 and 4% of your income for solid own occupation coverage, and it's meaningfully cheaper the younger and healthier you are when you buy it, which is exactly why waiting until you think you'll need it is usually the most expensive way to eventually get it. If you pay the premiums yourself with after-tax dollars, which is standard for an individual policy, any benefit you eventually collect comes to you completely tax-free, which meaningfully closes the gap between your disability income and your old paycheck. That tax treatment matters more than it sounds like on paper, because a policy replacing 60% of your gross income tax-free often ends up replacing something closer to 75 or 80% of what actually landed in your account as a normal paycheck, which is a far smaller gap to absorb than the headline replacement percentage suggests at first glance. Fourth, and this is the actual point of this entire video, if you're ever in a position where money is genuinely tight and something has to give, this is deliberately the last thing on the list, not the first. Cut the streaming subscriptions. Cut the dining out. Downgrade the car if you have to. But the expense that protects the actual engine generating every other dollar in your household is exactly the wrong place to look for savings, precisely because it's the one risk that, if it hits while you're uninsured, doesn't just cost you the premium you saved. It costs you the entire income the premium was protecting in the first place. Let me leave you with someone who kept the coverage through a genuinely difficult year. A woman named Bettina, 38, runs a dental practice. Went through a year where a divorce and a slow patient season hit at the same time, forcing her to cut nearly every discretionary expense in her budget, just to keep the practice's lights on. The disability policy stayed. She told me she'd actually sat down with a calculator during the worst month of that year, seriously considering letting it lapse for a few months the way Marcus once had, and the only thing that stopped her was doing the exact math I just walked you through. The future income at stake against the modest monthly premium protecting it. 8 months later, a car accident left her with a shoulder injury serious enough to keep her out of the operating chair for 5 months. The policy replaced 65% of her income for the entire stretch. She told me the premium had felt like the hardest one to justify during the worst month of that difficult year, purely because it was the expense she never actually used, month after month, right up until the exact month she needed every dollar of it. What she said afterward was that the year that nearly broke her budget was also, without her realizing it at the time, the year that made keeping the policy the single best financial decision she'd made in her entire career, purely because she happened to keep paying for something she'd genuinely questioned cutting just months before she needed it. That's really the whole point of this video. Most insurance feels like a waste of money for as long as it's working exactly as intended, which is precisely why it's the first thing people cut when a budget gets tight, and the last thing they should. Wealthy households don't protect this expense because they enjoy paying for insurance. They protect it because they understand, often from a planner who's walked them through the exact math I just walked you through, that the actual asset worth protecting was never the house or the car. It was always the income that pays for everything else, and that's precisely the one thing you can't easily rebuild once it's gone. I don't think this habit requires being wealthy to adopt, which is honestly the whole reason I wanted to make this video in the first place. It requires understanding one piece of math that most people simply never sit down and walk through, because nobody hands it to you the way an advisor hands it to a client with enough assets to pay for that advice. The odds aren't a secret. The Social Security Administration publishes them. The foreclosure statistics are public record. What's actually different about wealthy households isn't access to information nobody else can get. It's that somebody, at some point, sat them down and made them look at it directly, instead of letting the math stay comfortably vague the way it does for almost everyone else until the exact month it stops being vague and starts being their actual life. I'm Faisal. Thank you for listening to Sheikh Faisal.